What's up, guys? So we just closed two multifamily acquisitions, literally back to back at the end of December. One for $10,660,000, 52 units in Atlanta, Buckhead, best part of Atlanta, and another 144 unit deal in Abilene, Texas, both with separate partners, both amazing opportunities for our investors and the exact type of systems and processes that we teach in Multifamily Dealmakers. But I wanted to take this opportunity and do a quick video of how I actually evaluate a real estate deal in 30 minutes or less. I want you to use this next time you're thinking about investing in multifamily. I want to use this exact process because this is what we did with these deals. And if you follow this script, you're going to know very quickly whether a deal is worth investing in or not. Now, most people think you need a massive spreadsheet and hours of analysis to determine whether a deal is good or not. And the truth is, I can usually tell in about 30 minutes or less whether it's worth pursuing. So I'm going to walk you through exactly what I do to look at real estate deals in this video. All right. The first thing is not about the numbers. It's about the seller. Why are they selling? Who are they? Is there a problem that's being solved? Is the property distressed? I want you to take this home with you. All right. Most bad deals start with optimism. All right. Most good deals start with discomfort and a problem. So you need to figure out, why is the seller selling? Are they retiring? Is it a mom and pop? Is it a fund and perhaps they are at the end of their fund timeline and they have to get rid of the property? Is their loan coming due? What has happened a lot the past couple of years is that variable interest rates that were really low in 21, 22 are now coming due, or the rates are now 8, 9%, and people have to sell to get out of those variable rate products. So understanding the seller situation first. Number two, I don't usually do like a full market study, but I do want to know some quick market economics before I decide to pursue a deal, right? What's the job situation like? Are there economic drivers in that particular location that make it worthwhile, right? You can fix operations with any deal. You cannot fix a dying market. Is the market growing? Some of our mentees and some of my mentors even will look only in specific markets that have a population growth of, a population of 250,000 or more. I don't necessarily stick to those metrics, but it's something that you should definitely consider when looking at a market. What's the economics? What are the jobs like? What are the schools like? What is the crime like, right? You don't want to buy property in a real crime-ridden area. It's just not going to be good for operations, right? After I look at the seller situation, I look at the market, then I get into the numbers. There's really three particular metrics that I focus on. Number one, what is the in-place NOI? NOI stands for net operating income. What is the property actually producing today from a cash flow perspective? And that's easy to find out. You get the numbers from the seller, you look at their income, you look at their expenses, you get that in-place NOI. Now, not broker pro forma NOI, you got to make sure you know the difference. If it's broker pro forma NOI, that is what we call pie in the sky, right? That's the broker selling you the dream. Now, it's important to know what you think you can get from a stabilization perspective at the end of the day, but you're buying the property based on in-place NOI. And a lot of times brokers will price a property based on the stabilized pro forma NOI, and you got to be very clear not to fall for that trap. We want to know what the property is worth today based on in-place NOI. The second, what is my all-in basis, right? What does basis mean? Basis is your cost, right? That's actually a tax term. Basis is your cost. What is your all-in basis for the property? So you want to look at your purchase price, your CapEx, all of your fees, acquisition fees, closing costs. What's the all-in basis? That is going to determine how much you think you can make when you sell it, right? The same strategy we use in Multifamily Dealmakers and everyone uses in this game is the same strategy Blackstone uses, right? Everyone's heard of Blackstone, one of the biggest asset managers in the world. Buy it, fix it, sell it. That's seriously the strategy, and that's it, right? But you want to know what you're buying it for. There's a term in this business, you want to buy it right. How do you buy it right? You want to make sure what you're truly paying per door. And the third metric, that actually is the stabilized value, right? If things work well, what does it look like on the other side, right? Can we actually achieve these rents? Do we have market data that support a particular rent comp? If we think we're going to go in and add value to this deal and we're going to increase rents by $300 per unit, where in the market is that supported, right? You need to find comps. Your broker should be looking for that, but you should also do your homework on your own. Where can we find that? In our deal in Atlanta, the $10.66 million deal, it's a expensive price per door, $205,000 per condo. It appraised for $208,000. So we walked in as some equity, but the property next door was literally achieving $2,000 to $2,100 per month in rent. Our property is $1,500, $1,600 per month in rent. So we automatically have $300 to $400 per month in organic rent growth that we're going to achieve, and we have the comp that's literally right next door. So that's the kind of analysis you're looking at when you're going to do your evaluation of a property. The next thing you want to look at is the debt. Properties don't work well if the debt is not good, right? Most deals die. They don't die because of operations, although a lot of them do. They die because the debt is out of control. Your first line of options in multifamily is going to be Fannie and Freddie, right? Freddie Mac, Fannie Mae. These are quasi-governmental agencies that have a mandate to support multifamily housing and to loan on multifamily housing deals. They usually traditionally have the best interest rates, but there are requirements, right? You can't take a true value add deal to Fannie and Freddie. They want stabilized product only because they want to reduce their risk. So the traditional metric in Fannie and Freddie deals, 90% occupied for 90 days, right? So if you're buying a value add deal like the 60 unit deal we bought earlier in 2025 in May, that was not 90% occupied. It was about 80% occupied when we bought it. So we couldn't qualify for Fannie and Freddie. We had to go get a bridge product, right? If that is not going to work for you because of those metrics, 90% occupied for 90 days, then you want to look at bridge debt. Now, bridge lenders are typically more expensive, but I found an amazing bridge lending partner that has rates that are very close to Fannie and Freddie rates. And I'll be happy to share that with you. Just shoot me an email or a text and I'll give you the name of that lender. It's an amazing lending product. Now, those are larger deals. You can also look at traditional bank financing, conventional loans, go to your community banks and whatnot, but I typically stay away from those because they're usually recourse. What that means is you have to put up a personal guarantee when your personal assets are at stake. These other multifamily bridge lenders and Fannie and Freddie lenders are typically non-recourse, meaning you're not going to put up your personal assets. So spending some time and understanding the debt that you're considering when evaluating a property is going to be huge. Now, when you say what are assumptions, what does that mean? Well, typically in a financial model, you're going to assume rent growth, you're going to assume a vacancy rate, you're going to assume bad debt, meaning collections. These are assumptions, right? You want to make sure these assumptions are accurate, and you want to stress test those assumptions. Now, when you stress test them, that means your vacancy rate is 5%, right? You have a strong occupancy at your property. Well, what if your vacancy goes to 15%? What happens to your bottom line? Do you have enough money to pay the mortgage, right? Are you still cash flowing? You still cash flow positive? Those are important metrics to understand, to kind of, you're stress testing your assumptions. And the final thing that I do is I literally look for a reason not to buy the property. After going through all of this analysis, learning about the seller, learning about the market, learning about the debt options, right? Then looking at your financial pro forma, and then making sure the property fits in your buy box, I look for a reason not to buy the property, because 10 times out of 10, you do not want to buy a property that's not worth buying, that doesn't fit your buy box, right? You got to make sure you understand what your buy box is before you even get to the market, right? So I'm not trying to hit home runs necessarily on every single deal. I'm trying to stay in the game, right? So is the underwriting conservative? Are there multiple exit options? Are the incentives aligned between the operator and the limited partner? So these are things you want to find out prior to buying a deal. And if any one of those things is off, the market doesn't make sense, the seller you're kind of weary about, you can't find good debt, the investors you're talking to are not aligned with what you're trying to do, walk away, right? I want you to walk away. It's not worth going after a deal like that. And once you've been in this game long enough, you'll realize that some deals just fall into place. The pieces just fall into place, right? If you're doing your work and you've got the right support around you. Those are the deals that make sense, right? But if any deal seems difficult to close, or you're having to kind of convince yourself that it's a good deal, that's your gut instinct telling you it's not, and you need to walk away, right? So guys, this is how I evaluate deals. This is my thought process. I wanted to share that with you. It works for me. I've closed over $40 million of deals just in 2025 alone. If you want to learn how to think like this, how not just to chase deals, this is exactly what I share inside of my community. It's called Multifamily Dealmakers. There's a link in my bio. If you're interested in getting into a community like that, that has not only key principles, has investors, has people that can support your deal throughout the entire process and potentially partner with you, make sure you get in touch with me. Let's see if it's a good fit. Let's go.